For over 2 centuries, one family has appeared in every European debt crisis, from the post-Napoleon era to the 2011 Eurozone crisis, when Italian bond yields surged past 7% and the entire continent trembled. Yet most people have never heard their name. The Rothschild family doesn't just own a bank. They operate a financial network stretching from London, Paris, Frankfurt to Zurich, the key hubs that decide the fate of Europe's over €9 trillion bond market. For 200 years, they have advised governments, financed foundational projects, and participated in deals that could alter the trajectory of entire nations. And here's the most unbelievable part: they have done all of this without holding any political office. Their power doesn't come from votes, but from capital markets, from information, and from the elite networks they have built across generations. So get ready. This is the story of how one family quietly became the financial bloodstream of Europe, and why most of the world, especially Americans, has never truly noticed their presence. In Europe, financial power operates according to a logic very different from what Americans are used to. In the US, billionaires rise and fade with each generation. Rockefeller in the oil era, then Morgan in banking, followed by Gates, Bezos, Musk. Power changes hands as quickly as technology. But Europe is different. Here, power doesn't rise and vanish. It is preserved, nurtured, and passed down through centuries as part of national heritage. Financial dynasties like Lazard, David Weil in France, Wallenberg in Sweden, or the Swiss banking families have existed as silent pillars of European democracy. But among them, one family stands ahead of all others, seeing the direction of money before modern finance even took shape, and turning a family bank into the continent's first cross-border network, the Rothschilds. The story begins around 1770 in Frankfurt, when Mayor Amschel Rothschild, a goldsmith and money changer, gradually built his reputation by providing financial services to German princes. At that time, Frankfurt was just a small free city in the Holy Roman Empire with a fragmented economy, chaotic currencies, and banking almost non-existent in its modern form. But Mayer saw what his contemporaries did not. Real power lay not just in gold, but in the ability to move capital and information faster than any court. By 1800, Europe was entering the chaos of the Napoleonic Wars. In that context, Mayer made the boldest decision of his life. He sent his 5 sons to the 5 largest financial centers in Europe to establish separate banks. Nathan went to London, where the government bond market was exploding to a scale of £300 million, an enormous sum at the time. James went to Paris, where post-revolutionary France was seeking to restabilize its finances. Salomon went to Vienna, the control center of the Habsburg Empire. Karl went to Naples, the gateway for southern European money flows. Amschel stayed in Frankfurt, holding the roots. This wasn't just business expansion. It was the blueprint for a multinational private banking network, something Europe had never seen at the start of the 19th century. While traditional banks were limited by political borders, the Rothschilds operated above them. They built their own courier system, secret communication routes, and coded messages, allowing them to receive information earlier than the press, and sometimes earlier than governments themselves. This information advantage quickly became a market advantage. In 1815, as Europe held its breath, waiting for news from Waterloo, Nathan Rothschild in London received the outcome nearly 24 hours before the British Treasury. In a volatile bond world, where prices could shift by the equivalent of a year's national budget in just hours, knowing early was power. But power always invites opposition. As Napoleon expanded war across Europe, many old banks collapsed due to constantly shifting borders, blocked trade, and devalued currencies. The Rothschilds were different. Their 5-city network allowed them to shift capital to safer locations in just days. When Vienna was at risk, money moved to London. When Paris was unstable, James rerouted funds through Frankfurt. They became one of the few institutions able to keep providing credit during wartime, forcing monarchies to cooperate with them. Their first major drama also emerged in this period: accusations of profiting from chaos, rumors that the Rothschilds made fortunes from war bond fluctuations, and suspicion from the old aristocracy unaccustomed to seeing a Jewish family stand equal to Europe's elite. But unlike traditional banks crushed by history, this family not only survived but emerged stronger. After Napoleon's defeat in 1815, when nations were buried in debt and needed reconstruction from ruins, the Rothschilds were present in all 5 markets simultaneously. They connected credit between monarchies, financed national loans, and supported the restoration of European finance. By 1820, they had become one of the most influential banking groups in Western Europe, involved in national debt deals for Britain, Prussia, Austria, and France. And from there, they entered a new level of power, one where the next generation began from a position most rivals, if they still existed, could only dream of ending at. When Europe entered World War I in 1914, the entire financial order of the continent was torn apart. Empires borrowed massively to feed armies, currencies lost value, gold was drained from treasuries, and banks reliant on traditional trade quickly fell into crisis. But in that chaos, the Rothschild system demonstrated its full strength. The London branch, led by Nathan's descendants, became the central provider of credit to the British government, where war bonds were issued on an unprecedented scale exceeding £2 billion. The Paris branch, despite direct exposure to the battlefield, continued to help the French government raise capital for industrial recovery. In Vienna and Naples, the Rothschild network coordinated gold and foreign exchange, maintaining supply for essential transactions. No other bank in Europe held 4 financial gateways at once during wartime, making the Rothschilds an irreplaceable force in capital markets. When the war ended in 1918, Europe was exhausted. Germany faced enormous reparations, Austria-Hungary disintegrated, Britain and France drowned in public debt. Once again, governments turned to the names they trusted most. The Rothschilds played a key role in debt restructuring deals, recovery bond issuances, and advising national reconstruction programs. Banking was no longer just a place to store money. It became the life support pump for faltering economies, and this family was the one operating that pump. But their peak period was far from over. When World War II broke out in 1939, Europe plunged into chaos once more. The Paris and Vienna branches suffered heavily as German forces advanced, with many assets frozen or forcibly transferred. Yet in the storm, the Rothschilds' multi-center structure proved its worth again. The London and New York branches, out of reach of the conflict, became the 2 pillars keeping the entire family afloat. London supported British government financing. New York coordinated gold and foreign exchange through channels with the U.S. Treasury. The family network allowed them to move capital, store gold, and maintain international banking relationships, despite war tearing borders apart. This led many in political circles to suspect them of profiting from war. Malicious articles appeared. Even some lawmakers accused them of benefiting from bond fluctuations and buying distressed assets. But when investigations were conducted, the truth was brutally simple in a financial system where entire governments depended on credit and capital flows. No banking network could operate without profiting from volatility. They didn't manipulate wars. They simply understood its financial mechanics better than anyone else. And because of that, when the war ended in 1945, the Rothschilds once again became a central force in Europe's reconstruction. They participated in national debt deals, supported banking system restructuring, and advised governments in the Marshall Plan. But most importantly, they helped shape the new international financial institutions: Bretton Woods, the IMF, the World Bank, and the BIS. These organizations laid the foundation for the modern global financial system, one built on capital flows, liquidity, and trust. And the Rothschilds, having twice pulled Europe back from the abyss, became one of the silent architects of that new order. The 20th century ended with an undeniable truth. Wars destroyed many industrial empires and political dynasties, but turned financial families into the centers of modern world power. And among them, the Rothschilds emerged stronger, more experienced, and more profoundly influential than any rival. After 1945, Europe took nearly half a century to stand firm again. But by the 1980s, a bold project began forming in the minds of continental leaders: monetary union, creating a common capital market capable of competing with the United States. By the early 1990s, with the Maastricht Treaty signed, Europe officially entered its biggest financial game since World War II. But to create a common currency, nations needed 3 things: advisors of sufficient stature, a banking network capable of linking diverse economies, and market makers able to channel European capital into a new era. And coincidentally, or perhaps not, the Rothschild family provided all 3. Their banks in London and Paris began taking on pivotal tasks, advising on state-owned enterprise privatizations in France, Italy, and Germany, helping countries restructure debt to meet Maastricht criteria, and most importantly, organizing the first Eurobond issuances that helped build the framework for Europe's capital market. While nations debated how to limit budget spending, while finance ministers struggled to agree on inflation control mechanisms, the Rothschilds sat right at the negotiating table as technical experts, people who truly understood the real impact of each clause on the emerging multi-trillion euro bond market. By the late 1990s, as the euro prepared to launch, many critical transactions in the EU's financial standardization bore their mark, from determining currency conversion rates to establishing national debt restructuring procedures aligned with new standards to creating legal frameworks for the common bond market. But like Fiat running into de Gaulle, the Rothschilds' financial power also encountered unexpected limits. In Italy and France, some bank and strategic corporate acquisitions were directly blocked by governments over fears of excessive private power, especially from a family-colored private entity. Some left-wing politicians in Germany even publicly criticized private financial conglomerates' deep involvement in deals affecting national economic sovereignty. These incidents taught the family a lesson they had learned over a century earlier. Financial power, no matter how great, still has limits when it directly confronts politics. And to transcend those limits, they had to control not just capital flows, but also information flows. From the late 1990s into the early 2000s, they began shifting focus to soft power, investing in financial media, specialized market analysis publications, sponsoring top economics universities like LSE, Sciences Po, Bocconi, and building think tank networks in Brussels, where thousands of EU policies are conceived. Now, they didn't just advise governments. They influenced those who write policy reports, the academics shaping the next generation's economic thinking, and the research organizations making recommendations to the European Commission. In finance, expectations matter more than reality. And those who shape expectations shape markets by controlling financial information flows, analyses, outlooks, academic forums. The Rothschilds quietly steer how markets perceive risk, evaluate bonds, or forecast economic direction. When the euro officially circulated in 1999, the whole world saw Europe enter a new era, but few knew that behind this currency's birth stood a family network that had accompanied the continent through war, reconstruction, and innovation. And now, thanks to their deep understanding of how markets operate, they stepped even deeper into the heart of European power, not through political authority, but through something far more effective: the ability to make an entire market believe what they want it to believe. Once the euro had solidified its place in the global financial system, the Rothschilds understood that the new era would be determined not just by capital, but by information. If the 19th century belonged to gold, the 20th to bonds, then the 21st belongs to data, and they began shifting decisively in that direction. Quietly but firmly, the first step was gaining influence in financial media corporations, organizations that don't just report news but shape market psychology, not mass market newspapers, but the in-depth publications that bankers, investment funds, and finance ministers read every morning. Their impact lies not in readership numbers, but in who reads them. Alongside media, they aggressively invested in data companies, massive information repositories like Clarivate or Refinitiv, where billions of data points on bonds, liquidity, capital flows, and interbank transactions are processed daily. These companies don't just record markets, they explain them, and that analysis becomes the basis for thousands of global financial decisions. When you own the data, you own forecasting ability. When you own forecasting, you own power. And the Rothschilds understood this better than anyone. But they didn't stop at raw data. They moved into deeper layers of influence: risk analysis firms, organizations that assess the safety of national bonds, banks, and corporations. A 0.5-point change in a risk score can wipe billions of euros off the market value of Italian, Greek, or Spanish bonds in just 24 hours. And in many cases, those assessments come from units where the family holds stakes or strategic influence. A negative outlook report can add hundreds of millions of euros to a country's annual borrowing costs. A single concluding remark can create pressure, forcing governments to cut spending, raise taxes, or accept restructuring terms. No politics, just data, and how that data is interpreted. But all of this was truly exposed only when the Eurozone crisis erupted in 2011, when Greek bond yields soared above 30%, when Italy hit 7%, when Spain had to beg the ECB for help. The entire continent fell into chaos. It was in that moment that people clearly saw the power of seemingly cold, emotionless reports. A risk assessment from one of the analysis units, the Rothschilds influenced reversed market direction in hours. A liquidity data report recommendation forced major banks into emergency credit tightening. And an analysis published in a financial paper where they held stakes became the catalyst that forced the Italian government to change policy overnight. To the public, these were just market fluctuations. But to insiders, they knew those reports carried weight because of where they came from and which analytical system they reflected. And it was then that governments truly grasped the lesson the Rothschilds had understood for over 2 decades. Markets don't just react to events, they react to expectations about events. And expectations are shaped by information. When you control how information is collected, processed, and presented, you don't just observe the market, you lead it. In the Euro era, the Rothschilds don't need to own the biggest bank or the strongest fund. They own something far more important: the power to define risk, forecast trends, and create the narratives markets trust. And in finance, trust is power. Once information power was consolidated, the Rothschild family understood that the next step lay not in markets, but in people. History has shown that the rules of finance are written not only by experts, but by generations of policymakers, finance ministers, central bank governors, people whose thinking, mindset, and beliefs are shaped by the environments they study in and the networks they enter. And so the family began investing in a form of soft power most of the public never notices: academia and intellectual elites. From the 1990s onward, they sponsored international finance scholarships at Europe's top schools: London School of Economics, Sciences, Paul Bocconi, HEC. These programs don't just train the brightest students, they create a future leadership class forever tied to the values and networks the family has built. Many of them later become advisors to the European Commission, members of finance ministries, or key figures in major banks. In parallel, the family expanded influence into research institutes and think tanks, the places producing thousands of pages of analysis that governments use to craft policy. In Brussels, they hold seats on the boards of leading think tanks, where closed-door discussions on EU budgets, financial regulations, or energy strategies take place. In Paris, they fund research programs on European capital markets. In London, they sit on councils of independent policy organizations where new ideas on banking regulation and financial oversight are born. And within those networks, a soft power structure took shape: the European Financial Inner Circle. This isn't a formal organization with offices or logos, but its members, ECB heads, finance ministers from multiple countries, chairs of Europe's largest banks, and top academics, regularly meet at conferences, roundtables, and academic seminars directly or indirectly funded by the family. They share thinking, risk analyses, future policy directions, and when those figures assume new positions, they carry with them the ideology, relationships, and trust shaped during their time in the programs the Rothschilds invested in. Power doesn't need to be seized, it just needs to be planted in the right people. In an era where every decision on interest rates, public debt, or economic bailouts can alter the fate of an entire continent, close ties to decision makers can sometimes matter more than owning the biggest bank. Because when you influence the thinking of those who write laws, you don't need to write the laws yourself. And what makes this structure nearly unassailable is its naturalness. No one can point and say they control the system, because everything happens through scholarships, conferences, research, relationships. It's not a conspiracy. It's the culture of power in Europe. The Rothschild family doesn't need to appear in public or stand behind podiums. They just need to ensure that those who do stand there understand them, trust them, and think in the same framework the family has nurtured for over 2 centuries. And that is the essence of soft power. You don't need to hold office. You just need to influence those who do, entering the 21st century. As technology began reshaping the global financial system, the Rothschilds understood that their dominance in traditional banking, however strong, could not last unless they entered new fields: big data, AI, fintech, and the technological infrastructure of capital markets. If the 19th century belonged to gold, the 20th to bonds, then the 21st belongs to algorithms, and this family saw it before most of the market. From the early 2000s, they began making strategic investments in fintech platforms, companies providing interbank payment infrastructure and digital banking services across Europe. These investments were quiet, not bearing the family name, but positioned exactly right, at exactly the right time. Companies running interbank payment systems, cross-border money transfer platforms, and digital identity tools serving the financial sector. When blockchain started being seriously considered by banks, the Rothschilds entered that game too, not by speculating in cryptocurrencies, but by investing in businesses building blockchain infrastructure for central banks and major financial institutions. Projects like digital asset custody systems, digital euro testing platforms, or cross-border transaction authentication technologies all bear traces of investment funds in which the family holds stakes. Notably, they didn't chase the flashy crypto market, but focused on the infrastructure layer, where only those who truly understand the financial system see the real value. But the biggest turning point lies in data. The family began acquiring stakes in companies controlling research data, patents, and technological innovation in Europe, platforms that every university, lab, and major corporation relies on to assess scientific trends. By holding board seats, they don't just track innovation flows, they understand before others which sectors will explode, which technologies will become foundational, which companies hold the future. This isn't knowing the market ahead, but deeply understanding how the future market will be formed. With the AI analytics tools they fund, the ability to read data no longer depends on intuition or personal experience. Algorithms can process billions of data points on transactions, liquidity, risk, credit, price volatility in seconds, and deliver predictions that would take humans months of research to approach. As hedge funds and central banks begin relying on data for modeling, the AI analysis companies the family supports go even further, analyzing market sentiment, information propagation speed, sensitivity of different investor groups to each fluctuation. These are tools that don't just simulate markets, they help shape them. And when you participate in platforms supplying data, technology, and analysis to hundreds of major institutions, you don't just see the current picture, you see the structure the future picture will rest on. But power doesn't come from technology alone. Power comes from combining three elements: a financial network existing for centuries, academic and think tank influence built over half a century, and technological capabilities they are seizing in the data era. This combination allows them to see trends before they become trends, not because they receive secret information, but because the ecosystem they participate in, from risk analysis, patent data to policy advising, lets them sense market movements very early. In the modern financial world, those who master data infrastructure are the ones shaping the future. And after 250 years, the Rothschilds still stand in the right place at the right time, with the ability to connect Europe's financial systems past, present, and future in a way few families in the world can match. Over more than 2 centuries, one thing has become increasingly clear. The Rothschild family doesn't control Europe through orders, coercion, or spotlighted political seats. They control through influence accumulated over 200 years, built from a cross-border banking network, reinforced by information, academia, data, and relationships, in which generations of politicians, CEOs, and policymakers unconsciously grow up. They no longer stand outside Europe's financial system. They are inside it, as invisible architects who helped build it after the Napoleonic Wars, shaped it after 2 world wars, stabilized it during the Eurozone Crisis chaos, and now continue steering its flows in the era of data and artificial intelligence. Not every policy decision bears their mark. Not every market movement is created by them, but nearly no major shift in European finance occurs without passing through institutions, reports, or networks where they exert profound influence. They don't decide whether the euro will be strong or weak, but they help define the analytical framework markets use to evaluate the euro. They don't command finance ministers, but they train, advise, and shape the thinking of those who sit in those chairs. And that is the most durable form of power any family can possess. Not the power of position, but the power of the system itself. So when looking at Europe today, a continent of parliaments, elections, and transparency, one final question still hangs in the air. Does Europe truly run on democracy, or is it run by financial dynasties that have never left the backstage? Families whose power doesn't come from being elected, but from never being replaced. If you want to understand more deeply about the silent power structures operating the world of finance, subscribe to the channel right now. And if you want to see the next stories about the families that have shaped global economic history, don't forget to hit the follow button so you don't miss any video.